I'm Al Brooks, and I am recording a bonus video. Today I'm going to be talking about three relatively common small chart patterns: II, IOI, and OO patterns. And in this video, the first of two videos, I'm going to define what I mean by those terms. All three are breakout mode patterns. They're all sideways bars. Traders are looking to enter on a breakout, buy above or sell below. And if it goes one way and then the other way, theoretically, a trader would take both trades. And II is inside. It's consecutive inside bars. An inside bar is a bar whose high is at or below the high of the prior bar, and its low is at or above the low of the prior bar. Next, I'll talk about an IOI, which is an outside bar followed by an inside bar. By definition, if a bar is an outside bar, it has a high above the high of the prior bar and a low below the low of the prior bar, and therefore that prior bar is inside the outside bar. So it's an inside bar, an outside bar, and then another inside bar. And finally, I'll talk about OO, consecutive outside bars. An outside bar is a bar whose high is at or above the high of the prior bar, and its low is at or above the low of the prior bar. I want to begin with an overview of the three patterns. Again, they're breakout mode. Traders are looking to enter on a breakout, hoping that they are catching the start of a trend. On the left, I have three bars. This bar is inside of that bar. That bar is inside of that bar. So it's an inside bar inside of another inside bar, consecutive inside bars, or II. Next, I have an outside bar, followed by an inside bar. So there's an inside bar, an outside bar, and an inside bar. Anytime you have an outside bar, the bar before is an inside bar. And finally, I have three bars, and the bars are getting bigger. The high of this bar is at or above the high of that bar. The low of this bar is at or below the low of that bar. It's an outside bar, and it's followed by a second consecutive outside bar. These are breakout mode patterns. Theoretically, a trader buys above and sells below, expecting a trend. And if the breakout fails and reverses, theoretically, a trader would take the opposite breakout. So, for example, if a person bought on a stop above the high of the II, and then the market turned down and broke below the bottom of the II, a trader would short. So he'd buy above the II and sell if it fell below the lower of the two bars of the II. Whenever you look at a three-bar pattern like this, a sideways pattern like that, always assume that there are at least two legs up and two legs down on a smaller time frame. Typically, an II pattern is a triangle on a smaller time frame, and an OO pattern is an expanding triangle on a smaller time frame. A triangle has three pushes one way and two the other way. Now, what's so special about these patterns? Why am I talking about them? Well, the most important reason is they all have a good trader's equation. If you think about it, if you buy above the high of this bar and your stop is below the low of the II, the lower of the two II bars, the risk is small. You're buying here and your stop is here or below here. Not much risk if you're looking for a move that could last 10 or 20 bars. So very good risk reward. And the probability is pretty good. Anytime you have a breakout mode pattern, in general, the probability that a breakout will succeed or fail is about 50%. So 50% chance if it goes above the II, 50% chance it'll keep going up enough for a swing, 50% chance it'll reverse down and go below, and if it breaks below, 50% chance it'll go down for a swing. And sometimes if the pattern is especially good context, the bars to the left, a good signal bar, the probability can be as high as 60%. So for example, if you have any of these patterns after a sell climax, it often is a very good buy if the third bar is a bull bar closing on its high. And if it's coming at the end of a buy climax, especially if there's resistance like a double top, then if you have a third bar closing on its low, it's a higher probability sell. In those instances, the probability could be 60% that you'll get a swing trade. some examples. This is a bear bar, open here, close here. This is a bull bar, open here, close there. A bull trend rarely abruptly reverses into a bear trend. Opposite is true for a bull trend reversal. A bear trend rarely immediately, instantly reverses into a bull trend. Normally, a bull trend has to stop going up, at least for a few bars, before a bear trend can begin. And sometimes it stops going up and goes sideways for a few bars and creates one of these patterns. Sometimes you get more than 3 bars, but I'm talking today about 3-bar patterns. It's higher probability if you're looking to sell and you have a bear bar closing on or near its low. You'd sell below the low of that bar. Here, IOI, inside, outside, inside. You sell on a stop 1 tick below the low of that bar. If it's a forex market, you sell 1 pip below the low of that bar. And it doesn't matter on the time frame. This applies to all time frames. Outside bar, bigger outside bar. Theoretically, you sell below the low of that bar, but in general, selling below a big bull bar is not a particularly high probability thing to do. In this case, it's probably better to wait until you have a bear bar closing near its low and then sell on a stop below that bear bar. And here are examples. You'd sell on a stop 1 tick below that bar and put a stop either above the top of the II, the higher of the 2 bars, or the top of the move. So if this is a bull trend and you reverse down and get an II, you could put a stop just above the top of the bull trend since it's not much above that. So you're risking a little bit more and you're getting higher probability. Same thing here, IOI, you sell on a stop 1 tick below that bar. If it's a forex market, 1 pip below that bar and put a stop above the high. And then here an OO, let's say it's coming in a bull trend. If you sell here below that bear bar, you could put a stop above the bear bar, but this is not much higher. It's probably better to put the stop above the top of the bull trend. We're assuming this was a bull trend. We got the OO and then a reversal down. Now, I said breakout mode patterns, in general, 50% chance the breakout will succeed, 50% chance it'll reverse. Here we have an II, and we have a bear bar closing on its low, so it's reasonable to look to sell below the low of the bar. That's assuming that this is occurring either in a bull trend or a bear trend. It's much less reliable to trade any of these patterns if the market is sideways in a tight range. A trader would place an order to sell 1 tick below the low of that bear bar, closing on or near its low. Here it's in the lower third. He'd get filled here. And he'd put a stop either 1 tick above the II, the higher of the 2 bars, or 1 tick above the top of the move, which would be up here. If the market reverses abruptly like that, he would get stopped out of his short, either above that or above this, and then he'd have to consider going long. It's still a breakout mode pattern. It's a bear breakout that failed, and now we're having a bull breakout. Theoretically, a trader could buy on a stop 1 tick above the bull bar, or 1 tick above the high, assuming this is a rally, and then we have a high. Or he could wait and buy above the high of the outside up bar. This is a big bull outside up bar, a bull bar closing on or near its high. He could buy on a stop above that. Here's the follow-through bar. He could buy on a stop above the high of the follow-through bar. If a bear shorted here, he could reverse to long above that or above the II here. Higher probability if you get consecutive bull bars. We have a close above the top of the trend, assuming this was a bull trend, which is good for the bulls. You can buy on a stop above that bar, or you can buy on a stop above the high of the follow-through bar, especially when you have a pretty good follow-through bar. This is an example of that. You have a good follow-through bar. You have consecutive decent-sized bull bars closing on their highs, both closing above the pattern. Higher probability to sell on a stop above the high of this follow-through bar. You'd get filled over here. Higher probability, stop further away. But that's always the trade-off. Whenever you get a higher probability trade, the risk reward is going to be worse. There's less room for profit because more of the move has already taken place and the stop is further away. II, IOI, OO patterns are breakout mode patterns. Traders look to trade them in trends. They want sustained moves. They want a market where there probably are traders entering with stops above or below. Therefore, they're looking for reversal patterns or flags. For example, here we have a bull trend, and then we have an OO pattern, outside bar, outside bar. Traders look for either a resumption of the bull trend above, in other words, a bull flag, or a top, a reversal, below. In this case, they'll look to sell below the bear bar on a stop, one tick below the bar, and they did get their reversal. So OO, it could have been a bull flag. In this case, it was a top. And here we have an IOI pattern. There's an inside bar after an outside bar. It's coming in a trend. The market broke above, and we got more trend. Here, we have an IOI, but also a second inside bar. So it's both an IOI and an II. You could call it an IOII. That's what I would call it. Traders will enter with a stop above or below. In general, if you have bull bars closing near their highs at the end of the pattern, traders will be more interested in buying above. And if you have a bear bar as the third bar in the pattern, especially a strong bear bar, traders will be more interested in selling below, less interested in buying above. These are trend patterns, either for trend reversal or trend continuation. They are not limit order patterns. Here we have consecutive inside bars. We have 3 of them, but they're coming in a tight trading range. This is a limit order market, not a stop order market. A stop order market, if you sell below a bar, you're expecting a series of bars down below, like we have over here. You're looking for a trend. In a limit order market, you're expecting more buyers below bars and more sellers above bars. It's a limit order market, and therefore you should not be trading with stops in a tight trading range. In any of these patterns, this is an II, but any of these patterns, if they're coming in a tight trading range, especially where the bars are very small and the bodies are very small, it's better not to trade them. So yes, we have an II. In fact, we have an III, 3 inside bars. We have a bear bar closing near its low. We have another bear bar here, but the bars are all small and they're coming in a tight trading range. This is a limit order market. There probably will be more buyers below that bear bar than sellers. A limit order market is a market where traders look to buy at the low of the prior bar and buy more lower and then scalp out, and they sell above the high of the prior bar and sell more higher and then scalp out. This is not the kind of pattern where traders should be entering with stops. So if you see any of these patterns in a tight trading range, it's better not to trade them with stops and wait for some other pattern. It's better to wait for a strong breakout up or down, or for a breakout that reverses. So an upside breakout that reverses, and then maybe sell that, or a downside breakout that reverses, maybe buy that, or a very strong downside breakout and then start to sell because then it's a bear trend, or an upside breakout, then look to buy because then it's a bull trend. Consecutive inside bars, II. This bar is inside of that bar, this bar is inside of that bar, so I, inside, inside. These are what I would call perfect inside bars. Remember I said that an inside bar has its low at or above the low of the prior bar. If it's above, I call it perfect. So this is a perfect inside bar. Here's the second one. Low above that low, not at that low. High below that low, not at that high. Perfect inside bars have a higher probability of leading to a profitable trade. Here are some variations of an II pattern. This bar is inside of that bar, and I would say this one is inside of that bar as well. High of the bar is at that high, and the low is above that low. So I would still call this an II, but I think it's a little bit less reliable than a perfect pattern where the highs are lower and the lows are higher. Another example, so instead of the two inside bars having identical highs, here the two inside bars have identical lows. And then here's an example where all three bars have the same high and the two II bars have the same low. The two inside bars have identical highs and identical lows, but they're still II. The body can be bigger, but usually if you're getting shrinking bars, you'll get shrinking bodies. So more often than not, the body is the same size as the second bar or smaller. This would be unusual to have a bigger second body. In these examples, I'm not showing whether the bodies are bull or bear bodies. It doesn't matter. In terms of what I'm explaining here, the bodies don't matter. But as I said, if you're looking to buy, it's better if the third bar, the second bar of the II, closes at or near its high. If you're looking to sell, it's better if it has a bear body and it closes at or near its low. In general, the more perfect a pattern is, the higher the probability that you'll get a profitable trade. If you have a perfect II, lower highs, higher lows, and you're looking to sell, and this bar closes on or near its low, it would be a higher probability sell than if it had, let's say, a bull body. The more obvious a pattern, the more perfect it is, the more computers will recognize it, the more computers will trade it, the more traders will trade it, and the more traders and computers will chase it as it goes up, if we're talking about buys in these examples. For sells, it would be the opposite. If everybody sees it and it starts to go down and you start to get a series of bear bars closing on their lows, that's perfect. You'll get more and more traders willing to sell as it goes down. It increases the probability that you'll make a good profit. A bull bar, bear bar, bull bar, consecutive inside bars, and they're perfect. This low is above that low, this low is above that low, and we have lower highs. We have a bull bar closing near its high. It doesn't matter if this is a bull trend, this would be a bull flag. If it was a bear trend, it could be a reversal up, and you'd buy above the high of that bar. Place a stop to enter one tick above the high of the second bar. As I said before, if this second bar of the II had a bear body and it breaks out above, it's higher probability to wait to see if the entry bar is a bull bar closing on its high and then buy above the entry bar. It's higher probability buying above bull bars, especially bull bars closing at or near their highs. The stop theoretically is below the II. If this is coming in a bear trend and we get the II, you could put the stop here or below the low of the bear trend. Remember, if it goes above the II, it's a buy. If it goes below the lower of the two bars, it's a sell. So theoretically, you could exit below the bear bar, or you could go short below the bear bar, or you could exit or go short below the bottom of the trend, assuming this II is coming in a bear trend. I mentioned a few minutes ago, if you are breaking above an II and the second inside bar is a bear bar, it's still a buy above that bar. Some traders will buy above a bull bar. This is a bull bar, they'd buy above that. Others would wait for the breakout bar, and if it's a bull bar closing near its high, they'll buy above that. That's higher probability. The stop is further away, but the increased risk, that's the price you pay to get higher probability, and that's an okay thing to do. You could buy above the second inside bar, and you can put a stop either below the II, or if this is a bear trend, you put the stop below the bottom of the bear trend. Higher probability, buy one tick or one pip above the high of a bull bar. In this case, the entry bar, the breakout bar, is a bull bar. Here we have an inside bar following an inside bar, and we're breaking below it. But the close of the bar is above the midpoint of the bar, so that's not a particularly strong sell signal bar. Because when we were down here, traders bought and went up. It reduces the chances that a lot of traders will sell if it goes below that bar. And here's another bar with a big tail below. Theoretically, you could sell on a stop below this bar, but a lot of traders prefer to sell below bear bars that close on or near their lows. So it's higher probability to sell below this bar, one tick or one pip below that bar, and put the stop either above the II or above the top of the pattern. So if this is a bull trend, you'd put the stop up here. If it's a bear trend, then this is a bear flag, and you'd put the stop above here. You could sell below the II, or if you want higher probability, and many traders do, they'll wait for a bear bar closing on or near its low, and they'll sell below that bar and get filled over here. Here we have an II, and what do you notice? It traded below the II, triggering a sell, and on the same bar, it immediately went above the high of the II, the first of the two inside bars. So what do? First of all, I don't like to sell below a bull bar, but technically it's okay to do that. If you did sell below the bull bar, you'd get filled here on your short. In the same bar, your stop would get hit, and that's okay. You could reverse to long above that, or you could wait for a bull bar closing near its high and get long above this. Here, in this case, we have the opposite. We have an II where the second bar has a bull body. Only a small bull body, but a bull body. You could sell below the low of that bull bar. You could sell below this bar because it's below the II and it's a bear bar closing near its low. Or you could sell below the low of that bar, a bear bar closing on its low. We have 4 bars, and the second and third bar are consecutive inside bars, II. Now, I want you to look at this. Remember I said every II, every IOI, every OO has at least some kind of a double top or a double bottom. And here we went down, we went up to the high of that bar, we came down to the close of that bar. At some point we were up at the high of this bar, and then we closed down here. So in this particular case, we have a low and a higher low, so it doesn't look like a double bottom, but it's a type of double bottom. And we have 2 highs. So there's a double top and a double bottom. In this case, same thing. We have a low, we have a second low, and we have a high and a second high. Remember I said that IIs on smaller time frames are usually triangles. At a minimum, they're going to be at least a micro double top and a micro double bottom. And that's why I call it a breakout mode pattern. It's a small trading range. Micro double bottom, this low and that pullback to the close of the bar from the high of the bar. Micro double top, we went up here, down to the close, up here, down to the close. And as I said, it's probably a triangle on a smaller time frame. On this time frame, there's a micro double top and a micro double bottom. Same thing over here, a micro double top on this time frame and a micro double bottom on this time frame, that low, and then the pullback from that high to that close. And if you looked at a smaller time frame chart, you'd probably see a triangle. Here's an II, a 5-minute chart, and we're breaking above it, consecutive inside bars. Usually a triangle on a smaller time frame chart. If you look at a 1-minute chart, you'd see we have 3 lows, 1, 2, 3, and 2 highs. And a trading range where you have a lower high and 2 higher lows, that's a triangle. This looks like this. This is the 1-minute version of that. And you can see it's a triangle, and we're breaking above the top. Not every triangle is an II on a higher time frame. So you could probably find some time frame where the triangle is an II, but it's not worth looking. Also, if you see an II on the time frame that you're trading, it's not worth looking at a smaller time frame to see a triangle. You know it's there. This is a monthly chart of Bitcoin, consecutive inside bars. And here's a weekly chart of Bitcoin. We have 3 highs, 1, 2, and 3, and 2 lows, a triangle. And we have a bear breakout here, and this is the bear breakout on the weekly chart. Look at this, 4 consecutive inside bars. This bar is inside that, and then we have 3 more inside bars. So we have 4 consecutive inside bars. No different from an II. It doesn't matter if the pattern has 3 inside bars or 4 inside bars or 100 inside bars. It's still a breakout mode pattern, and it's going to be a triangle on a smaller time frame chart. 60-minute, 4 consecutive inside bars, 5-minute chart. You can see it's a triangle. Always assume that every II or III or III is a triangle on a smaller time frame. And that really doesn't help you. It might help you feel more comfortable that it's a breakout mode pattern because the triangle is a more common or more classic breakout mode pattern. But it doesn't matter. The market's sideways and we're contracting. We're in breakout mode. Whether or not you know it's a triangle on a smaller time frame chart, you're going to trade it like a breakout mode pattern on the chart in front of you. With a breakout mode pattern, as I said, 50% chance the first breakout up or down will fail, and 50% chance you'll get an upside breakout, 50% chance you'll get a downside breakout. And sometimes you get both. Here we went down and up. Here is a triangle late in a bear trend, so a bear trend and a triangle. And a triangle late in a bear trend is typically the final flag, final bear flag. It's an area of agreement. Traders think this price is fair. If we break out to the downside or to the upside, the market will tend to gravitate back to this fair price. So it's often the final flag in a bear trend. If you get a downside breakout, you're probably soon going to come back to the apex of the triangle. This is a 5-minute chart, and on the 60-minute chart, if you looked at it, you'd discover that this triangle was, in fact, an II. If you're trading the 60-minute chart, you would assume this II is a triangle on a smaller time frame chart, like a 5-minute chart. IOI, an inside bar after an outside bar. We have an inside bar. The bar before it is an outside bar, and therefore the bar before the outside bar is an inside bar, and therefore we have an inside, outside, inside bar. Again, a breakout mode pattern. This is an example of a perfect IOI. The low of the outside bar is below, not at, the low of the prior bar. The high of the outside bar is above, not at, the high of the prior bar. And then the inside bar that follows has a high below the high of the outside bar and a low above the low of the outside bar. And here are some variations. This bar is inside because its low is above the low of that bar and its high is at the high of that bar. Again, the more perfect a pattern is, the higher the probability is you make money. But here are some variations where the inside bar has a high at the high of the outside bar, not below. And here's another example where all 3 bars have identical lows, but the outside bar is above both inside bars. Another example where the outside bar is perfect, but the bar after it has a high at the high of that bar and a low at the low of this bar. Therefore, this bar is an inside bar, but its high is at that bar, so it's also an outside bar. Its low is at that low, so it's also an outside bar. So this is an IOI, and it's also an OO. This bar is an outside bar. This bar is both an inside bar and an outside bar. So you can call it either an IOI or an OO. It doesn't matter. Both are breakout mode patterns. We have an outside bar, and the second bar is a bear bar. This could be in a bear trend. It could be a bull trend, so it could be the top of a bull trend. It could be a bear flag in a bear trend. we have a bear bar closing on or near its low. Traders will sell on a stop 1 tick or 1 pip below the low of that bear bar. It's a higher probability IOI because it's perfect. It looks very good. We have a big bull bar, and then we have a bear bar closing on or near its low. That's a pretty reliable pattern. You put a stop above the top of the pattern, the IOI. And here's an example of an IOI. Instead of getting a bear breakout, we have a bull breakout. But remember what I said. It's in general a higher probability trade to buy above a bull bar closing on or near its high and not above a bear bar. Theoretically, you could buy on a stop above this bar. Here's a bull bar. You could buy on a stop above that bar. I usually wait to see the entry bar and then buy on a stop above the entry bar. When you have a bad signal bar like this is a bear bar, it would be better if it went below and triggered a sell. Instead, we're going above, triggering a buy. That's lower probability. So instead of buying above this bar, I would buy above that bar. If instead this bar went below that bar, I would sell below the inside bar. You could buy above the IOI, but if you want higher probability, it's better to buy above a bull bar closing on its high. So you buy on a stop 1 tick or 1 pip above the high of this bar and get filled over here. Here we have 5 bars. We have an IOI, bars 2, 3, 4, breakout mode, and we broke out above. And here we have the same pattern, but we broke out below. Reasonable to sell below bar 4, a bear bar closing on its low, and an IOI. Here, less reasonable to buy above that bar because it's a bear bar. Bars 2, 3, and 4 form IOI patterns. We went up, and then we went down to that low, right? We went up here, and here's the close, so we were going down. And then on this bar, we went above that bar, and then we have a bear bar here, so we went down here. So in this pattern, we have at least a micro double top and a micro double bottom. That is what you often see in breakout mode patterns. The market making several attempts to go up or down, and then traders are looking for a breakout. Here, there's a micro double bottom, and we also have a micro double top, this high and that high. Here, it's in a bull trend. This is a high 1 bull flag. That's the high of the bull trend. We have a pullback. It's a high 1 bull flag above that bar. You could buy above the bear bar, you could buy above the bull bar, or you could wait for the breakout bar, and if it closes near its high, buy above the high of that bar. In this chart, the market went from that low up to that close and up to that high, and then it went down to this low, and then it went up to that high, and then down here, bear bars is going down. So there's a micro double top. Bar 2 and 3 formed a micro double top. And 2 and 4 are a low 2 top. We went up here, we went down. We went up here, we went down. This bar went below that, so it's a first reversal. And now we have a second reversal, so that's a low 2 top. Bar 4 is a high 1 bull flag, but it's a bear body, so it's a lower probability buy. I talked about that here. The high 1 buy did not trigger in this example. In this example, it did trigger, but the example on the right, the buy did not trigger, but the low 2 top did. Outside, outside, OO. An outside bar followed by another outside bar. The high of the bar is above the high of that bar. The low of the bar is below the low of that bar. It's outside, and then there's a second outside bar. A perfect OO because the lows are lower and the highs are higher. And it doesn't matter. The bars could have bull bodies or bear bodies. What does matter is if the bodies are big and the tails are small. If the 3 bars are little doji bars in a tight trading range, it's a limit order market. You should not be buying above or selling below. But if the bodies are pretty big, for example, if we have a big bull bar, a big bear bar, a big bull bar, you'll get traders more interested in buying above the high of that bull bar. Variations. Here, the low is below that bar, this low is below that bar, and the high is at that high instead of above. So it's still an OO pattern, but it's not perfect like this where the high is above the high. And then here's an example where the third bar, the second outside bar, has a low at the low of the first outside bar, not below. And then here's an example where the second outside bar is identical in height and has identical highs and identical lows. A perfect OO. We have a bull bar, a bigger bear bar closing on or near its low, followed by a bigger bull bar closing on or near its high. Let's say this is a bull trend. You have a bull bar closing near its high. Some traders will buy above the high of that bull bar, and they'll get out either below the low of that bull bar, or they'll wait for a bear bar and get out below the low of that bar. And other traders will reverse to short. If you have a failed buy and then an outside down bar, they'll sell below the low of that bar. And then here, it goes back above the high of that bar. So you have bulls buying above this bar, and you'll have some bears selling below that bar, and these bulls lost money when it went below that bar or this bar. These bears lost money when it went above the high of the signal bar or above that bar. So we have trapped bulls into a bad long, trapped bears into a bad short. That increases the chance that if we get a third breakout, it'll be profitable. For the bears, they see a two-bar reversal. We went up, we went down. They sell on a stop below that bar, just after the bulls had a failed buy above that good-looking bull bar. And then the bears got stopped out, and the bulls have a second buy signal bar. I'm not saying you should take that buy and that sell. It depends on context. You might take it, you might not take those two signals. However, once you see the two signals, and then you see the market go above this bull bar, this is usually a pretty good buy. You'll have trapped bulls, trapped bears, and now a bull bar closing on or near its high. That's a reasonable buy. And it could be in a bull trend, in which case it's an OO bull flag. It could be in a bear trend, in which case it's an OO bottom. If you're looking to buy, you want to be buying above a bull bar closing on or near its high. Now, one difference between an OO and the other two patterns, II and IOI, is the third bar in the other two patterns is small. It's an inside bar. So the stop is not as far and the risk is relatively less. When you're trading an OO pattern, the third bar is big. It's a second consecutive outside bar, and the stop is further away, and your risk is greater, and you should always trade small enough so that you're not risking any more on any trade than you are on any other trade. So very often with an OO pattern, you have to trade a little bit smaller position size. A perfect OO and a not so perfect OO. This low did not go below that bar, and therefore, yes, you might have triggered a buy above this bar, but we did not trigger a sell below that bar. We did not go below the low of that bar. And some bulls would still be long. They'd have a stop below a bear bar, and they would not have been stopped out. Over here, theoretically, bulls would buy above the bull bar, sell below the bear bar. So you have bulls losing money, bears losing money, and if you have a third breakout, which you have here, it's a higher probability trade, higher probability that you'll make money. Again, you don't necessarily take the first buy or the first sell. You do depending on context. But if you see the OO and a perfect OO like that, you know you had trapped bulls, you know you had trapped bears, this becomes a higher probability buy. Here, depending on the context, you might buy above that bull bar, but you never got the short. It never went below the low of the bear bar. A lot of the bulls who bought here might hold and get out below a bear bar. So a lot of these bulls are still long, even though we went below that bar. If you did buy here and did not get stopped out, you could buy more here. If you did buy here and got stopped out, you could buy there. It's a second buy signal. What do you think about this? We have 3 bars with identical highs and identical lows. It's a variation of an inside pattern, II. This is an inside bar, did not go below that. It's an inside bar, did not go above that. And then you have a second inside bar. But it's also a variation of an IOI. This bar, it's an inside bar, but it's also an outside bar. An inside bar has a high at or below the high of the prior bar. An outside bar has a high at or above the high of the prior bar. So this bar is both an inside bar and an outside bar. And the same with this bar. It's both an inside bar and an outside bar. So in addition to being an II, it's also an IOI. You could view this as an outside bar and this as an inside bar. So this is an II and an IOI. And it doesn't take much to realize that it's also an OO, because this qualifies as an outside bar, and so does this one. So it's consecutive outside bars as well as consecutive inside bars. Is it an II, is it an IOI, or is it an OO? As I said, it's all 3, and it doesn't matter what you call it. You're looking for a breakout mode pattern, and no matter how you look at it, it's a breakout mode pattern. Traders are going to buy above, they'll sell below. 5-minute chart, we have consecutive outside bars. On a smaller time frame chart, here a 1-minute chart, you should assume that it's going to be an expanding triangle. Just like the mirror image of this, consecutive inside bars is a contracting triangle. Consecutive outside bars on a smaller time frame chart is an expanding triangle. It doesn't matter if you have a contracting triangle or an expanding triangle, both are breakout mode patterns. Here's a 60-minute chart, and we have an outside bar and then a bigger outside bar. You have to assume it's going to be an expanding triangle on a smaller time frame chart. And here's a 5-minute chart of that. The brown box here is the same as here. 2 hours of trading here, 2 hours of trading here, and the OO here is an expanding triangle here. I talked about 3 small sideways patterns. They're all breakout mode patterns, and they could be bull flags, they could be bear flags, they could be reversal patterns. So if you have one of these patterns at the top of a bull trend, it's a bull flag and it's a possible top. You buy above, you sell below. If you have one of the patterns at the bottom of a bear trend, it's both a bear flag and a reversal pattern. You sell below, you buy above. II, consecutive inside bars. IOI, inside bars before and after an outside bar. And then OO, consecutive outside bars. I'm Al Brooks. Thank you so much for your attention. I hope that you found the video helpful.